Everyone. Till now in mathematics or finance, the topics that we have covered, we first talked about normal simple interest and compound interest. In that, we talked about principal and amount. Then those terms later on became present value and future value. Yes. Then we talked about the scenarios where if it was one-time payment, then we are talking about present value, future value. Fine. But if there is a multiple payment, if I'm making, suppose in order to repay a loan, I'm paying an installment again and again, or in order to get a huge sum of money later in the future, I'm making an installment payment, I'm making deposits again and again. So any payment that is made again and again, that will come under annuity portion, right? So when we talk about annuity, that's equal payment in equal interval of time. So what type of annuity are we going to talk about? We are usually going to talk about annuity certain, or we are going to talk about perpetuity or perpetual annuity. Now what was annuity certain? When we already know when the annuity is going to end. It starts now, that we know. But when it will end, after 5 years, after 7 years, after 10 years, such an annuity is known as annuity certain, and that is what we are majorly studying here. Second that we will talk about today also is perpetuity. What's perpetuity? That goes on forever. Now when we talked about annuity certain, there are two types on the basis of when the annuity payments are made. If the annuity payments are made at the end of the term, it is known as ordinary annuity or annuity regular. Sorry. And if the payment is made now, in the beginning of the term, right away, then it is known as annuity due or immediate annuity. When you are talking about annuity, it can be either ordinary or due. And in both the scenarios, it can be present value or future value. Whenever we are talking about loan, so what is loan? I have a need of money today and I don't have that kind of a money with me right now. So that's why we take the loan. So the need is when? Today. Because if I would have known that I'm going to have a need of sum of 2 lakh in the future, I won't take the loan. I'll make deposit so that I can accumulate that amount of money till that duration, right? So whenever it is a loan, it is always going to be present value. In order to repay the loan, you are paying annuity installments, right? So when we are making these annuity installments, in that scenario, it can be if the term is made in the end, it is going to be ordinary, and if it is made in the beginning, it is going to be due. If I'm making deposits where I'm going to get the sum of money at the end of the term, that will come to future value. Yes. So we talked about four formulas: future value, ordinary due, and present value, ordinary and due. So were you able to calculate the sums and do it on your own?
Yes, ma'am.
Yes, ma'am.
Today we are
Yes.
going to talk about different scenarios altogether, different varieties and different instances, right? The first thing I'm going to talk about is need. What is need now? For example, like companies do, they have taken a huge sum of money as a loan and they don't want to pay it as an installment. They'll repay it in one go. So what they do is they start on a sinking fund account where they are going to deposit an amount where on which they are going to get an interest, which after a period of 7 years they are going to get a huge sum of money, and that amount will be used to repay any debt that we have. Or for example, as I said, if I am, for example, I want to purchase a rental property after 5 years. So I know that after 5 years I'll need a huge sum of money in one go. Say I need 1 crore of rupees. So for that I'll tell to the bank that this is my requirement, right? And for this what I want is I want to save the money from today, right? So you tell me the interest rate that you are telling me, I want it after 5 years. How much should I start paying now? Right? I'll tell you whether I want to make the half yearly payment. For my case, I'll say I want to make half yearly payment. So I want to make half yearly payment for 5 years. And at the end of 5 years, I want you to pay me 1 crore of rupees that should have the interest accumulated in it. So now we need to find out how much should I pay every 6 months so that I can have that much kind of money accumulated in that duration, right? So again, this 1 crore of rupees I'm accumulating for a fixed purpose in order to buy a new asset, in order to buy a land or a property, whatever it is. So whenever we have a fixed motive of doing something, whether it is to repay any liability or in major cases to purchase any new asset, whether it's a small machinery. For example, if I have a factory and in the factory I have huge machinery, I know that the life of those machines is like, for example, if it runs in full scale, it is max 10 years or 7 years. So after 7 to 10 years, I need to buy that machine again. Say the life is 7 years. So the machines are not like cheaper. They're very expensive. Suppose the machine is costing me 5 lakh right now. So after 7 years, it's going to cost me around 6.5 lakhs to 7 lakhs. So what I need to do is I want to accumulate 7 lakh of money rupees in 5 years or 7 years, whatever is my shelf life, so that I can buy that new machine when it gets wear and tear. Agree? So what we do is we accumulate money in order for future. Such a scenario is known as sinking fund. Such a scenario is known as sinking fund. Such a scenario is known as sinking fund. So when we are talking about sinking fund, it is basically for two purposes. First, to repay or clear out any liability, or to purchase a new asset. To purchase a new asset. Right? These are the two requirements that I have. Either to repay any loan or to purchase a new asset. Yes. And when we are talking about sinking fund, see, I'll be having the need in the future. So sinking fund is always future value. Always future value. Right? Because if I have the need today, I'll take a loan. I have the need in the future. So I'm accumulating, I'm depositing installments so that I can accumulate a huge sum of money at the end of the term. So that is future value. Clear? Yes. Usually when we are talking about keeping aside our money, so when I'll do that, when I have profit, I won't take it from expense, right? If I'm earning 1 lakh, my expenditure is say 80,000, I have 20,000, 10,000 maybe miscellaneous expenses. The remaining 10,000 is my saving. Agree? So how will I know that? Once I know my income or my profit if I'm running a business. So this amount I can only set aside from my profit. Agree? So profit will be what? End of the term. I can't know my profit in the beginning of the term, right? I can only know my profit at the end of the term. So in general, until and unless said otherwise, sinking fund is always future value ordinary annuity. But if they specifically mention that yes, I want to buy a new asset, but I'm starting the payments from today. If I'm starting the payments from today, then I will apply future value and annuity. If they specifically tell me, in general, sinking fund is always future value ordinary annuity. So for sinking fund, I don't need to have another formula. It's the same formula. Sinking fund, basically I'm finding what? Future value or amount of an annuity. Future value or amount of an annuity. Same formula, R 1 plus I to the power n minus 1 by I. Same formula we will use. Yes? Guys, clear?
Yes, ma'am. Yes, ma'am.
For example, for example, for example, I'm setting aside a sum of rupees 10,000. Setting aside a sum of rupees 10,000 at 10% per annum so that I can buy a car after 10 years. So since a specific purpose is written, right? A specific purpose is written. What is the purpose? To buy a new car, buy a new asset after a period of 10 years. What I'm doing is I'm setting aside the sum of rupees 10,000. Since I haven't mentioned anything, so it is going to be annually, right? So what we want to find is the sinking fund amount. So amount will be R. R is 10,000 because I'm depositing that again and again every year. 1 plus I will be 1.1 power 10 minus 1 by 0.1. Let's calculate. Answer. Answer. Guys, answer.
One lakh 59,374.24.
Very good. Everybody, did you get this answer?
Yes, ma'am.
All of you?
Yes, ma'am. Yes, ma'am.
Okay. Next question. How much amount should we set aside? How much amount should we set aside every half year so that a sum of rupees 10 lakh is available to repay a loan at the end of 7 years at 8% per annum. So what do we want to find? The sum of amount that I'm setting aside every half yearly. So what is the question asking us to find?
Annuity.
Very good.
Annuity.
So this 10 lakh will be
Future value.
future value amount. So solution amount R we have to find. What rate are we going to take?
4%.
4% because it is half yearly. So I will become 0.04. 1 plus I will be 1.04 to the power 7 years. 7 years means 14 installments. Yes or no? By 0.04. Do you have an answer?
5,46,689.7.
Perfect. 5,46,000. 54,668. Yes?
Yes, ma'am. Yes, ma'am.
Any problem, guys? Guys, clear?
Yes, ma'am.
Yes, ma'am.
All of you? So
Ma'am.
whenever there is a fixed purpose, we are talking about sinking fund. In sinking fund, we are always going to apply the formula of future value ordinary annuity. But if they would have specifically mentioned somewhere that no, the payment starts from today, then apply future value annuity to formula. Done? Now we move on to a new annuity, that is perpetuity or perpetual annuity. Something that goes on forever, like sometimes pension or your property tax. As long as you have the property, you need to pay that tax. So that's forever. So any annuity that goes on forever is known as perpetuity. So since we are talking about forever, see, There are present value annuity question, there are future value annuity question. Sinking fund, future value annuity question. Now when we are talking about perpetuity, if I am getting 1000 rupees every month, like a scholarship for example, 1000 rupees every month as long as I live. So for me that is forever, right? So in this scenario, this is my annuity, 1000 rupees monthly. Okay. How can I calculate future value? Future value means what? After 5 years, after 7 years, after 10, after 100 years. But there is after, na? There is a time. But if this goes on forever, this is indefinite. So I can never say that I'm about to find out future value for a perpetuity. No, it cannot happen. In perpetuity, there can never be a concept of future value. Why? Because future value will require an ending period. In a perpetuity, there is no end period. So in perpetuity, there is no concept of future value. There is no concept of future value. But what we can do, like we did a Samna commuted pension. For example, every month I'm getting 1000, 1000, 1000. We find out my life expectancy. Say I'll get that 1000 for 30 years. Okay. So according to that, what is the equivalent sum today? Right? That I can find like a commuted pension sum that we did. So instead of talking about future value, which we can't because there is no end period, we can talk about an equivalent amount for today. For today, we always term it as present value. So in a perpetuity, there is no future value. There is only present value. Online, did you understand?
Yes, ma'am.
Yes, ma'am.
There is only present value. So for present value, we'll be having two types of formula for perpetuity. Ordinary annuity and annuity due. Ordinary annuity and annuity due. While ordinary annuity, we are going to talk about R by I because there cannot be N. There can be annuity, there is present value, there is rate, phi. But there cannot be N. N means what? After 10 years, after 15 years. I have no end of time. So I cannot have time here. So we only have present value, annuity and rate. Out of these three, two will be provided. The third we need to find. Yes. And if it is annuity due, it is R plus R by I. It is R plus R by I. Understand? For example, find the present value of annuity of rupees 1000 payable half yearly at the rate of 6% per annum continuing forever. Continuing forever. Since the word continuing forever is here, this means that it is perpetuity. Now, did I mention in the beginning or in the end? I did not. So, if nothing is mentioned, we will take ordinary annuity. So, present value will be R upon I. R is annuity 1000, which we are talking about half yearly, right? So, 6% will become
3%.
6% will become
3%.
3%. I is R upon 100. So 0.03. I is 0.03. Calculate. Answer.
Three 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 point
33,333.3. Yes? Guys,
Yes,
clear?
ma'am.
Yes, ma'am.
Suppose find the present value of an annuity Find the present value of an annuity of rupees 2500 paid in the beginning of every year at the rate of 5% per annum, continuing forever. If the word continuing forever would not have been written, then I would have given you the time, right? So, which type of annuity is this?
Annuity due.
Because it's written beginning of every year. So, present value is R plus R by I. R is 2500. 2500 upon I is 0.05.
52,500.
52,500. Yes?
Yes, ma'am.
Any doubts?
No, ma'am.
All of you?
Yes, ma'am.
Now you'll realize when we do the exercise, you have already done the first two exercises, right? There's only one more exercise. We have already done that. These are extra. In your examples, you will see in the module example, you will see a lot of variety. Whether I should buy a machinery or not, whether I should rent my property or not, or I should sell it out, or whether I should have a property, for example, in an institute, whether I should have my own institute or I should take it on rent, right? So there are so many different scenarios that we are going to talk about. But when we talk about the exercise, we don't have those questions. So let us first do the third exercise, right? Then we will move on to those varieties which are peculiar. These are there in the examples, one of a kind. We'll do those later. Let's move on to the exercise. Let's start. The present value of an annuity of rupees percent per annum compound interest. So we have to find out the present value. So 3000 1 minus 1.045 to the power minus 15 by 0.045. Yes. Guys, answer for the first one.
Option B.
32218. I got 0.63. Done.
Yes,
Yes,
ma'am.
ma'am.
Next, the amount of an annuity is future value. Amount of an annuity is future value. So for 150, 1.035 power 12 minus 1 upon 0.035. Answer 2190.29. So option A.
Yes,
Option A.
ma'am. Yes, ma'am.
Question number 3. A loan of rupees 10,000 is to be paid back. Loan, that means its present value, has to be paid back in 30 equal installments. The amount of each installment is to cover the principal and at 4% compound interest. 1 minus 1.04 power minus 30, 1.04. Answer. Question number 3. C 578.30.
Yes,
Yes.
ma'am.
Question number 4. Entire formula is given. The formula looks for present value. Just put it 1 divided by 1.08 for 12. Sign change, add 1, multiply by 1200 divided by 0.08. Answer D.
Option B.
9043.29, right? Question number 5. Formula is wrong here, huh? The formula is wrong. Use the correct formula. In question number 5, use the correct formula. Huh? A is annuity, time, rate. We have to find out future value. That means ordinary annuity formula. So 1.05 to the power 10 minus 1 divided by 0.05 multiplied by 100. Answer
Option A, ma'am.
option A 1257.8. Question number 6. The amount of an annuity after 25 years at 5% per annum compound interest is 50,000. We need to find out the annuity. So we know the future value. We need to find out the annuity value. So 50,000 equal R 1.05 to the power 25 minus 1 divided by 0.05. Answer Answer B 1047.622.
Yes, ma'am.
Question number 7. Rupees 100 amounts to rupees this number of years will be. Trial and error you can do. So what we have here 3137.12, this is 100, 1.045 to the power n minus 1 upon 0.045. So 3137.12 multiply 0.045 divided by 100, add 1. So 2.4117, 1.045 to the power n. Now we can do trial and error. I first isolated n, sent everything there. 100 got divided, 0.045 got multiplied, 1 got added. So now I have got 2.4117 is same as 1.045 power 9. So let's calculate. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. In 20, I have got 2.4117. So answer is 20 years.
Yes, ma'am.
B 20 years. क्या होता है करो आप 3137.12 divided by 100 into 0.045 plus 1 कितना है वही हम लिखा है इसका वैल्यू so we want that so now 1.045 keep on multiplying and keep the count as soon as you get a value near that tell me the count online till here is it okay
Yes, ma'am.
Yes, ma'am.
question number 8 a company borrows so loan rupees 10,000 on a condition to repay it with a compound interest of 5% per annum by annual installment of 1,000 each. Annuity is 1,000, 1 minus 1.05 to the power minus n upon 0.05. So isolate that. 10,000 divided by 1,000, 10, multiply it by 0.05. So 0.5 is this. So 1.05 power n minus n is 1 minus 0.5, that is 0.5. So keep on dividing. Tell me the answer that you are supposed to get. 2, 3, 4, 5, 6, 7, 8, 9, 10. At 10 I got 0.61. At 10 I got 0.61. 11, 12. At 12 I got 0.55. At 14 I got 505 and then I got 4.48. So it is near 14 years. 8. It is near 14 years. Yes or no, guys?
Yes, ma'am.
All of you, are you able to do the sums?
Yes, ma'am.
Yes, ma'am.
What? 9. 9. Mr. X borrowed rupees 5120 loan at 12.5% per annum or 1.125 to the power minus 3 divided by 0.125. Yes? Calculate. Answer.
Ma'am, can't we apply the, shouldn't it be the compound interest?
My fault. It's not even an annuity formula. Mr. X borrowed rupees 5120 12.5% per annum. At the end of 3 years, the money was repaid. There's only one payment. It's a normal present value, future value formula. Thank you. It's a normal present value, future value formula. I have borrowed 5120, my loan amount, my principal. I got my interest at 12.5%. At the end of 3 years, I'm going to repay with the interest. So I want to find amount. Amount will be principal 1.125 to the power 3. Amount is 7290. So what would be the amount of interest?
2170.
2170. Done?
Yes, ma'am.
Thank you. Next, Mr. Paul borrows rupees 20,000 on the condition to repay it with compound interest at 5% per annum in annual installment of 2,000 each. So I'm making 2,000 again and again. So this is annuity question. Loan annuity. So 20,000. This is 2,000. 1 minus 1.05 power minus n by 0.05. So 20,000 divided by 2,000, 10, multiply it by 0.05 and subtract it from 1. 1.05 power minus n. Same only. Right? Same calculation as we did earlier. So answer is 14.2 years. Yes?
Yes, ma'am.
Yes.
All of you got the answer?
Yes, ma'am.
This sum we already did. A person invests rupees 500 at the end of each year with a bank which pays interest at 10% per annum compound interest annually. The amount standing to his credit 1 year after he has made his yearly investment for the 12th time. So first, for the first 12 years, we'll find out the future value and then on that we will add 1 more year's interest. So first future value for 12 years. 500, 1.1 to the power 12 minus 1 upon 0.1. This is 10692.14. This is after 12 years. But I'm going to deposit this money with the bank for one more year. So I'm going to get extra 10%. So add 10% on it. It is 11761.36. Yes or no?
Yes, ma'am.
Yes, ma'am.
Question number 12. The present value of annuity. We need to find out the present value. Annuity for 5,000. 12 years 4%. 1.04 power minus 12.04. 1 divided by 1.04 multiplying 12 times. Sign change. Add 1 divided by 0.04 multiplied by 5,000. Answer?
Option D, ma'am.
46925.36. So fine. 40. A person desires to create a fund to be invested at 10% compound interest to provide for a price of 300 every year using V equals to A by F. Use this formula. Because it is neither future value nor is it present value, they have given us a formula, apply. So A is my annuity 300 divided by I is 0.1. So it will be 3000. That's it. Got it? It is basically, they did not say, but it is basically a perpetuity question. Any doubt, guys?
Oh, ma'am.
Guys, clear?
Yes, ma'am.
Yes, ma'am.
There is one more exercise. That's your homework. It's same. Present value, compound interest, simple interest formula, nothing fancy. Yes? That's your homework. We'll see in the next session.
Yes, ma'am.